Please stand by. Today's call is being recorded, and you are now live with your audience.
Thank you, Stephanie, and welcome to Wellington's first quarter 2017 conference call. I'm Howard Milliner, Wellington's CFO. I'll make some comments on the financial performance for the quarter, and Greg will then provide an update on the business as we progress into Q2 2017. We said on the last call that there was a lot happening in the business, and that position has not changed. I'll start with the usual warning. We'll be making some forward-looking statements on this call today, and as these are predictive in nature, they're subject to a number of risks and uncertainties relating to Wellington, its operations, and the market in which it competes, some of which are beyond the control of Wellington. Actual results and conditions may differ materially from those expressed or implied by such forward-looking statements. The results for the first quarter 2017 was an EBITDA profit of $600,000, a $508,000 improvement compared to quarter 1 2016. The EBITDA result has been adjusted to remove the impact of FX revaluations on the preference shares. The EBIT result for the quarter improved by $580,000 to $199,000 profit for the quarter. Revenue in New Zealand dollar terms was up 30% to $12.7 million. We sold 11% more EC motors than in the comparable period in 2016. For our new ECR2 and SCF Connect products, we sold more in the first quarter than we sold for the entire 2016 year, and these sales were to both of the major carbonated soft drink brands. Almost all of these SCF Connect sales included a data access component. Gross margin was 24%, up from 22.1% in Q1 2016. Some of this improvement can be attributed to higher margin new products, but cost reductions continue to be secured for legacy products as well. We're always looking for cost down opportunities with our suppliers. Cost for our ECR2 motor is presently higher than we initially contemplated, and we're working hard with East West to take cost down by engineering and lower cost components, and also through leveraging increased volumes. We are starting to hear from our suppliers that they are seeing increases in commodity prices, for example, steel and plastic resin. We're working with suppliers on ways to mitigate these impacts and are using our increased purchasing leverage from higher volumes to support mitigation. At this stage, we believe that we can continue to improve gross margins, albeit not at the same rate as in previous periods. Operating costs were $2.7 million for the quarter, compared to $2.1 million for Q1 2016. The $600,000 increase in the quarter is due to headcount increases to support growth in the SCF Connect business, as previously signalled, increase in the warranty cost provision due to higher volumes of the new products and extended warranty offers to major brands, and planned higher travel spend to support the business development and support activities on SCF Connect and the rollout of new products. We closed Q1 with $2.5 million of cash, $1 million net of the supervised loan drawdowns, which was 0.4 better than we closed 2016. Inventory was $3.4 million, with inventory turning 2.6 times in the quarter, so that's 10 times annually, which continues to reflect the strong inventory management process we have in place. As the board discussed at the annual shareholders meeting held late April, we're exploring options to repay and replace the supervised loan facility, which is due for repayment in September of this year. We are pursuing a trading bank finance facility as first priority. This month, the convertible preference shares convert to ordinary shares. It appears likely that the weighted average price for the 20 days of $4.90 for May will be above 24 cents, so the prefs will likely convert at a 1-to-1 ratio. They have been accounted for at an amortized cost of 25 cents per share. So to the extent that the weighted average price for the conversion exceeds 25 cents, we will be required to account for the premium within the finance cost line of our P&L. So, for example, if the share price on conversion is 26 cents, that will be a $252,000 interest cost to recognise based on 25.2 million ordinary shares being issued. At 27 cents, it would be a $500,000 charge. These are, of course, non-cash charges and are not trading activity related. At this point, I'll hand the call over to Greg.
Thanks, Howard. Hello, everyone. Let me start my comments by saying that I'm continue to be excited by our growth prospects Customer adoption continues at some speed for our SCS Connect products in particular, and our expanding ranges of software and data tools are getting noticed by the market. We had several new customers also now sampling our SCS retrofit device, which will help customers enable connectivity for coolers already in the field. We shouldn't forget about motors either, with ongoing volume growth in our ECR motor range, led by our advanced ECR2 motor and actually also our cost-leading ECR82 92 motor. As Howard mentioned, our first quarter was very solid, significantly better than first quarter last year, with that 30% increase in revenue and improvement in EBITDA and EBIT versus the same period last year. Our ECR2 motor and SCS Connect controllers had very strong quarterly sales, and we have no reason to think that won't continue. 3 of our 4 sales regions experienced pretty decent growth, with USA and Canada up 160%, Latin America up 66%, and Asia Pacific up 29% compared to last year. These 3 regions are all seeing growth driven by our ECR2 and SCS Connect products, as well as increases in our legacy motors. We have successfully expanded the customer base in all 3 regions and are continuing to focus on customer additions. Of particular note are the new SCS Connect field trials being supported by some of the brands in the Americas, which includes our new digital marketing and consumer engagement tools that we supply in partnership with iProximity. Our 4th region, EMEA, or Europe, Middle East and Africa, lagged as expected, with revenue lower than Q1 2016, reflecting the ongoing difficult macroeconomic environment in that region. We're working through a review of our European business right now, focused on 3 main areas to see how we can improve customer acquisition and growth. As we've said in the past, economic and political uncertainty in Europe is still the main driver in these lower demand patterns, and that region also tends to be our most fragmented market where we see the strongest competition. Even with that as a backdrop, we feel there are still some things we can do to improve sales growth. This review will be focused on, firstly, potential new investments in sales and customer support infrastructure. For example, do we need to add specific skills in specific countries where growth is more likely? Secondly, we'll be looking at product range, where we will review whether country or regionally specific products are required beyond our existing roadmap. One example here could be on the SCS product, where clients in the European region seem to be expressing more of a need for cellular-based connectivity versus our existing Bluetooth product. And thirdly, we will be continuing to explore further sales partnerships, similar to the successful one we have already started with Axia in the UK. In the first quarter, we announced our exclusive partnership with iProximity, an innovative Australian-based digital marketing solutions provider. The selection of iProximity as our digital marketing software provider followed a global search for enterprise-capable beacon management providers, and was also subsequent to customers telling us they had interest in this type of product. This new offering is focused on our smarter cooler platform, giving our customers the ability to move from just connecting with a consumer to true consumer engagement. Our smarter cooler platform is cloud-based and allows for simple management of proximity-based marketing campaigns delivered through our SCS Connect and the refrigeration system. Selected examples of what we can do with this platform are: we can rate a consumer's phone with a branded message installed in a cooler with SCS. We can deliver contextual, personalized promotions based on consumer purchasing habits. We can deliver partnering opportunities with retailers for our customers, build real-time data insights into consumer actions, and through the SCS Connect and iProximity tool, engage with consumers with personalized and relevant offers that drive engagement for our brand customers. This smarter cooler platform really does move us from a pure hardware play to a software and solutions provider at the iBeacon enterprise level. I should note, though, that our strategy is not to become a SaaS or software service business. Rather, it is to augment our existing hardware offering with value-added software tools that solve problems for our customers, problems such as tracking their assets, improving product sales, and engaging with their consumer clients. On to our supply chain now. How is our supply chain performing? Generally, all of our strategic hardware suppliers are performing very well. The main supplier project underway at present is to bring on additional SDS capacity at East West, which we expect to be completed by the end of this quarter and which will help us meet the SDS demand growth that we are seeing over the next 18 months. In addition to the pricing pressure that Howard mentioned on selected component commodities, we are also starting to see indications of supply constraints on some silicon-based parts. We understand these constraints to be as a result of increased global demand for silicon from both the automotive and the mobile industry. So we're implementing a number of programs to ensure supply, such as issuing longer lead time orders to secure capacity in the supply chain, and implementing alternate parts in our products to give us increased supply and cost flexibility. Finally, how is our first half looking? With a strong Q1 in the bag, we're now focusing on ensuring we support all of our customers' product needs as the Q1, Q2 peak demand season comes to a close. We are continuing to see demand patterns generally higher than Q2 last year and consistent with first quarter 2017. It's too early to tell how demand will end up for the end of Q2 and into Q3, as customers tend to reduce demand visibility and shorten lead times at this time of year as they head into summer months. We are seeing some of our larger customers delay or cancel some Q2 orders as they adjust their needs heading into the summer season. That said, we continue to expect revenue growth and profit performance ahead of second quarter in 2016 and consistent with the first quarter this year. Our full year guidance remains unchanged, which is for revenue growth in the 30 to 40% range and EBITDA profit in the low millions of dollars. So that ends my comments. Thank you for listening, everyone, and I'll now hand it back to Stephanie for Q&A. Stephanie.
Thank you. If you would like to ask a question, please signal by pressing star 1 on your telephone keypad. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, press star 1 to ask a question. We'll pause for just a moment to allow everyone an opportunity to signal for questions. And it appears there are no telephone questions.
Okay. And that means my comments were full and answered them all up front, hopefully. Last chance, any questions from anyone on the phone?
And there are no questions at this time.
Okay, no problem. Excellent. Happy to take any questions offline. Feel free for anyone on the phone to call either myself or Howard directly. We're looking forward to continued good second quarter to round out the half, and also look forward to updating you all after the second quarter has ended to let you know how it's gone. So appreciate you calling in and have a great day.
That concludes today's call. Thank you for your participation. You may now disconnect.